Now, let's talk about mobile money, specifically the steady drumbeat of calls to separate the wildly successful mobile money service, M-PESA, from its parent company, Safaricom. Now, to be clear, this is not new. It's been around for a while. If you go back to 2017, for example, a draft report produced by Analysis Mason at the sector regulator's request initially recommended splitting M-PESA away from the parent company, but then the company walked that position back. In 2021, a proposed bill aimed to compel telcos to form separate entities to handle businesses outside their core enterprise, voice, text and data. That bill, however, it should be said, went absolutely nowhere. Now, one of the main arguments for why Safaricom should be split lies in its sheer size. In the quarter ending in June, for example, it handled 90% of text messages sent in Kenya, 66.1% rather of voice calls. But if you go back to the quarter ending in September 2021, Safaricom accounted for nearly 2/3 of all active SIM cards and 98.5% of all mobile money accounts. And remember, to date, this is a package deal. You only get an M-PESA account if you have a Safaricom SIM card. Now, for context, here's what M-PESA looks like in comparison to Airtel Africa's operations across 13 African countries. And yes, that includes Nigeria. Roughly 18% of its clients, or about 21.7 or so million people, were using Airtel Money across 13 countries, with transactions worth about $46 billion. In 2021, Safaricom had over 50% more clients and handled 4.5 times more transaction value in one country. So if Safaricom is to be split, how exactly would that happen, and what effect would it have not just on consumers, but on regulators and the businesses that have come to rely on it as their payments backbone? Tracy Kivunyu is a Senior Equities Analyst at SBG Securities, a subsidiary of the Standard Bank Group. We spoke about this some hours ago.
At this moment, we know that the conversations are shifting more towards the creation of legal entities, separate legal entities. So by that, we're talking about Safaricom, for example, being a holding company and having M-PESA as a fully owned subsidiary housed within the holding company. Currently, if we look at even how Safaricom and other telcos have been reporting their mobile money numbers, it's been as part of their telco franchise. So what would happen would be, first, you'll see that there would be better visibility regarding how you see the financials that are pertaining to M-PESA being viewed by both the investors and the central bank. So the first thing we'd likely to see is that we'll see separate accounts for mobile money entities, but the operations are largely likely to remain the same.
From a banking perspective, because I know there's always been this tension, right, between traditional banks and M-PESA, given its sheer size. There's now a conduit for money moving through for P2P payments, for business-to-client payments, and so on and so forth. Would banks be a little more comfortable dealing with a standalone M-PESA as opposed to dealing with it in its current form today?
That's difficult to say because I would not say that the element of competition is eliminated by the fact that M-PESA would be a separate legal entity. The competitive benefits or advantages that M-PESA has over the banks would still continue to remain. And considering the penetration of financial services in Kenya and arguably for most of Africa, is that the mobile telecom service tends to be the first point of access to financial services. And that's unlikely to change just because of the dynamics that we have in this country. What is likely to happen is perspective is that banks are not going to be materially affected in terms of their choice to partner or not to partner with the platform. I would say at this point, just looking at the dynamics of electronic transactions passing through mobile money platforms, the banks, they have it in their best interest to partner with mobile money firms so that they can get the best services to their customers as well as expand their product suites.
All right, one last question for you, Tracy. Safaricom's had a particularly bad year in the market so far, down around 32% to date, down to around 25 and a half shillings per share. What is the sentiment around this stock? Why has there been a general sell-off that still continues even after the election period essentially is over? The campaigns are done, there's a new government in place. What are the concerns that investors have here?
I would say the concerns that we're seeing on the stock are not particularly on a fundamental basis. We still think that there's upside potential if you look at M-PESA usage, which we've just discussed, and we still see strong free cash flow generation from the stock. Most of the factors that we're seeing happening to Safaricom is first because as the most liquid counter, it would have the biggest impact in terms of showcasing investor sentiment in the Kenyan Stock Exchange, which is why we would see that the downside on Safaricom has been much more pronounced than other counters. But would say the bigger factors here is the macro-political environment, both globally and locally. Globally, the fact that we're seeing inflation hiking, we're seeing an increase in terms of fuel pricing and concerns about currency access even coming here to Kenya means that we starting to see concerns from the foreign clients in terms of access to currency. Second, we're seeing concerns about inflation and how that's going to affect disposable incomes. And if we look at this macro-political environment, both globally and locally, then it gives foreigners some cause for concern, because then they would be more comfortable in safe haven assets, maybe in offshore developed markets compared to frontier markets where you have that currency translation risk. So I think that's what's really affecting the valuations of the stocks at the moment. But on a fundamental basis, I would say both the banking, consumer, and the telecom industry still look relatively undervalued in our view.